Hello, Tom Levecchia here with a very special edition of the New Theory podcast. We have a very special guest today, Michael Mikhail, who is the founder and CEO of Stratton Equities. Michael, welcome to the New Theory podcast. How you doing today, man?
Doing very well. Thank you. Appreciate it.
All right. So we're going to jump in and talk some finances, real estate, especially in this tumultuous market. One thing I like about what we talked about offline, you see a lot of opportunities, and that's where you make money. When everybody kind of is going for the door, that's when you should be coming in. So before we jump in, give a little bit of background and tell us a little bit about yourself, Michael.
I've been in the mortgage business about 20 years. Founded Stratton Equities late 2017 to early 2018. We're doing very well. We're growing at an astronomical rate right now.
Nice.
Yeah, we're one of the largest private money and non-QM lenders in the nation. We lend in 44 states, and a lot of people are very. I'm very optimistic about the future of this market, depending on a couple of things that could go left or right, but I don't think it's going to be as bad as people say it is. And a big reason for that is also, like we talked on the phone, there's no inventory in the market. And that's a big reason of what's holding things back right now is a lack of inventory. But people don't understand there's multiple silos. They just think it's a market. And it's not just a market. You have the financial market, you have the credit market, you have the secondary market, you have multiple markets that you have to look at to really see kind of what's going on and get kind of a pulse on things. There's not just one market.
Yeah. And one thing is I want to say is after the kind of 2007 to 2009 collapse,
we don't use those words. We don't use those words. Those are bad words.
Exactly. Ooh. So 2007, 2009, I'll say economic challenge in the real estate and the financial industry. In my personal opinion, and I believe you timed it right, it presented challenges. So for example, even for myself, I have 2 LLCs. I have a good banking relationship. I have a great credit score, but I find myself getting money. I got a merchant cash advance before. I've gotten a no-doc loan. So give us kind of why you got into this and then why you kind of got it right and why your loans make sense and maybe more so than 10 years ago.
So again, what happened 10 years ago was a big collapse of the secondary market, and then we flooded with real estate. That was the time to buy, right? Yeah. A lot of people is they were buying 2006, 2007, top of the market. And then those loans were toxic loans. We don't have the toxicity in the market that we do back then. Like, there was, I'll just say 2 loans to you that were crazy that I didn't do them because I didn't believe in them. One, they were doing 100% financing, right? Yeah. And they were doing it on owner-occupied properties. So the big thing is when owner-occupied property, your income is supposed to be offsetting the mortgage, taxes, and insurance.
Correct.
You do them on no-doc loans, and they're not really no-doc, but it's on an investment property. So your income as the borrower is not supposed to be supporting that property anyway. Your rental income is supposed to be supporting and offsetting that mortgage. Okay, so that's different. But back then, there was a loan where not only was it 100% financing, they were financing you 125% because they were expecting the market to keep going up and keep appreciating. That if you bought a property today, they're like, oh, market's gonna keep going up. They gave you 25% cash back at closing. That's insanity. And what do people do? They went and bought drapes and bought a new car. And that could have been a great mortgage. Well, really not great. But if you're a smart investor and you pocketed that money and rolled that money to go do other things, but they didn't do that. They bought drapes and carpets and a new car. Right? Yeah. So the money was gone. So we don't have that toxicity in the market that we do. I'll give you an example. Education is very big for us coming in 2023. People don't understand. They just think, hard money. They don't understand the non-QM world, the no-doc loans, and the benefits that come with it. And I'll give you an example of one loan we just closed a couple weeks ago. When last year, when rates were in the 2s or whatever, the only benefit to going to a bank or a credit union was the rate. But then if you're doing a 1 to 4 family investment property, and you're going to, I can't name names, but any of the banks you can think of, the credit unions you can think of, they're going by conforming and conventional and agency guidelines, which is 70 LTV on a 1 to 4 family investment property. Okay. So it's 70 LTV. With us, we're not looking at your job history. We're closing an LLC. Yeah. We're not nitpicking and looking at the borrower's personal income, right? Because it's offsetting. We're looking at the property debt servicing, and we were at 80. We were at 85, which was amazing. We were at 85 LTV. We're at 80 LTV now on a purchase. So the only benefit previously to a bank or a credit union was, okay, my rate might be a little lower. Now we're at a higher LTV. We're at 80 when a bank's gonna be at 70. We're pretty much lower than a bank. We did that loan at 7.25 and a 5.1 just only a couple weeks ago. Your rates are going to be going up soon, but that's what it was. So there's really no benefit right now if you're a clean borrower to go to a bank or a credit union when you can come to a company like ours. Now, again, these programs, a lot of them are pretty proprietary to us. A lot of companies are 65 or 70 LTV, so it wouldn't make sense. And their rates are higher than ours. But with our programs, it does make sense to reach out to us first.
Well, so just I know we have a lot of entrepreneurs and a lot of people that are kind of know what you're saying, but I kind of want to boil it down a little bit. So first, LTV is loan to value. So I want to buy $1 million property. The higher LTV there is, the more the little I have to put down. The less the LTV, the more I have to put down. And what a bank does is they generally have unfavorable. They're like, listen, you only get 70%, which means a 30% down payment, versus if I partner with Michael and his firm, Stratton Equities, it only may be 20%. So I have to put down less. So I conserve cash, could use it for improvements, right? Or use it for whatever I want. And then the second thing is, which is more of a more recent phenomenon with interest rates. Typically at a bank, and they would give you 3.5%, and then respectfully, Michael might come in at 6%, right? But with this craziness in the economy, that Michael's rates, or a guy like Michael's rates, are comparable to a regular bank, a lower criteria to get an investment property, which I want to get to an investment strategy in a second. So it just makes it more attractive than it has in the past. So I do want to ask you, and I'd rather you explain it because you'll do it better than me. You said no doc, non-QM. Just define those terms for our audience as well.
So when most people want to get a mortgage, right? They go to the big mortgage companies, their credit union, their bank, and they don't understand that's all the same guidelines. It's a different company name. All agency, conventional, or QM loan. QM is qualified mortgage. So after 2008, a ton of regulations came into place so that those days won't happen again. And they made all these ridiculous regulations and policies, which made it very strict and very tight for people to secure financing. So when you go to any of these companies or any of the big companies which people know about, that's all they offer. That's their market. And the irony of it is if you look at the American population, I forgot the exact number, but it's between like 5 to 7% that fit into qualified, clean loans with their credit, their income, their job history. We service, if I would ballpark it, 40, 50% of the U.S. population, people that are self-employed, people that don't have a 2-year job history, people, that, whatever the case may be, right? So we service a much larger demographic of people than the conventional and the conforming space. When you talk about non-QM, non-qualified mortgage, so out of qualifying mortgage guidelines, and that's when you're doing, let's say, a bank statement loan, right? Oh, my income as a W-2 person is not enough. I'm self-employed. I don't have W-2s. You can't go to a bank. You have to do a non-QM loan. That is still, we do those. That's still not as aggressive as where we live in our world. We're private money. So, and we do have the non-QM for people that could fit, but our biggest programs are no doc and our soft money. Now, I created the soft money loan and coined it what it actually is. And that was a hybrid between private money, hard money, and conventional, in the sense where, you know, rates are much softer, costs are much softer, but you're getting some of the benefits of the lower rates, the LTVs of, you know, one of those loans, but you're not spending the hard money price, you know, rates at double digits and all the costs that come with hard money. You're not dealing with the craziness and the compliance of dealing with a bank where, why is your firstborn child named this that they want to, it's like, what is it to you? Just lend them the property.
So, okay, so this is important. Okay, so for those that are watching, you kind of discussed, you know, non-QM, you discussed conventional. Can you just go a little bit on the definition of soft money and what it is and how best to leverage it?
So again, soft money, hard money, soft money, right? So hard money loan, and most people don't know what a hard money loan actually is. Like people call and go, oh, I want a hard money 30-year. Doesn't exist. I want a hard money fix and flip. Okay. That's not a hard money loan. A true hard money loan is an asset-based loan.
Correct.
Where you're not looking at the borrower. If somebody has a recent bankruptcy, by the way, this is only on investment in commercial properties. Second home, owner occupied, doesn't qualify.
Correct.
Is anybody in the country. So if somebody has a recent bankruptcy or foreclosure, if somebody, whatever, you're looking at the equity and the asset much more than the borrower, which is a hard money loan. That is always going to be your bridge loan. So it's going to be 6 months, 12 months, 24 months, 24 is even going far, normally 6 to 12 months. Now, that world is what started the world that we're in now, right? So those mortgages started to get institutionalized 2011, 12, 13 is when it started. When I bought my first property, I was 19, I think it was like 2000. My rate was 24%. Ooh. Because there was no institutionalized private money, right? It was literally a guy in Florida that retired, wearing a Hawaiian shirt. That's like, hey, kid, go ahead, have fun, right?
Wow.
My rate was 24%, but it got me to where we are today. So with the soft money, it is institutionalized, so the rates are much lower. You get the benefits of the higher LTVs, but you're not being scrutinized like a bank loan, and then you're also not getting the only being a bridge loan, which is what a hard money loan is. So it's a great option, and especially for self-employed people, right? Correct. People that are self-employed, banks do not like them. They make it extremely difficult. Anybody knows if you're self-employed, you go to a bank, it's not going to, or a credit union, it's not going to be easy if you can even get a loan. So our programs are really conducive, and that's why we designed them for investors, realtors, entrepreneurs. You know, somebody that's a real estate agent. You'd be surprised how many real estate agents can't get a loan. They can't get a loan. They don't have the job history.
They can sell the house, they just can't buy the house.
And the reason are A, their job history is sometimes a little shaky, and B, their income. The way they're on commission. Sometimes they go a month or two without getting an income. That's it. You can't do a bank loan. You're done.
Correct.
But
so okay, us, so go ahead.
So we have those options for them.
All right. So I'm following this. Okay. So basically, you have more attractive opportunities. Okay. Hey, I got to put down, let's say 25%. The interest rates, based off a few factors. Let's be honest. I personally never call it a no doc loan. I will call it a low doc loan. Obviously, that's just me personally, right? But I will say it's much more attractive. So my first mortgage that I got for this house right before the pandemic. I don't want to say too much, so I don't want this to get demonetized and get this pushed down in the ranks. But we closed February 14th, 2020. And I have 2 LLCs. I don't have W-2 income. So I had to submit like 100 documents for a non-traditional loan. And I then bought a second piece of property, which was low doc, 25% down. And I literally submitted like 2 documents, a little higher interest rate, but again, it's an investment property. So although, we don't want to give investment advice per se, but what do you say to somebody who's looking to get into this space, right? Call Stratton up. They identify maybe a 4-unit property, an 8-unit property, a 3-unit property, right? How much should they put down? What are your recommendations? And let's kind of give some good advice as a guy who would get them that money.
Well, I mean, the big thing is before you even come to us for money, like a lot of problem with people is, and I see this all the time, it's like they're not a qualified borrower, right? Credit, whatever the case may be.
Yeah.
Instead of taking the time and cleaning themselves up, fixing up their financial situation, they're going to run around like a chicken with its head cut off, trying to find somebody that's going to finance more property. Don't do that.
Correct.
Right?
Correct.
And then what they do is they find something with a lot of work, and then they go throw money down as a down payment, thinking they're helping themselves. And then they're like, oh, if I don't close, I'm going to lose. We don't even take those clients on, right? Because like they're literally trying to pass their problem on to somebody else.
Correct.
That's your problem, right? Correct. And now, if I don't close, I'm going to lose my earnest money.
Yep.
We told you can get a mortgage in the first place.
Correct.
You know what I'm saying? Like, so don't do that, right? Be a cleaner borrower. If you have money, if you have liquidity, clean up your credit first. Clean yourself up, right? Credit is always going to be huge.
Yes.
Right? There's no program that doesn't look at your credit. None. Like we had somebody that was apparently qualified, but he had no trade lines. He literally, I do everything in cash. I have nothing in my name. Well, I mean, so technically, right? If we could have done a hard money, the hard money loan for him because we don't care about that.
Yeah.
But his property didn't qualify for that. So if you want to get a term loan, a soft money loan, a no doc loan, an 80 LTV, purchase, or 80, 75 LTV cash out, which is our biggest programs,
Correct.
you're not going to get it without any trade lines. The big thing is people don't understand how many programs there are out there, especially with us. Always the concept of Stratton from day one was to have the widest range of programs under one roof, so that our loan officers can say yes more,
Correct.
and they can help more people, and
Correct.
it helps everybody, because by our loan officers being able to qualify more people, it obviously helps them financially, and then we're able to help more people because we can put them into mortgages much more easily. The big thing is a lot of people have been shopping around. I've been shopping for 6 months, and I just found you guys. Then we can get it done. So people should be finding us first.
Well, I actually, I want to kind of reiterate that point. I'm a big believer in this. So, for example, I have my lawyer, I'll have a tax accountant, I'll have
got to build your team.
Yeah, you build your team, and one area that I get frustrated too, because I get asked for advice, I do some consulting, and people will come to me and say, "Oh, I shopped around my mortgage." No, you go to a Stratton and you say, "Hey, here's my situation," and then this, Michael, you'll have 7 different options. And I listen. I always say this, right? You're gonna listen if you have poor credit and you don't have a lot of money down, and you're able to get approved. Expect like the Shylock rates, like it is what it is, right? I'm not saying you get what I'm saying. Like you're going to have a higher rate if you have a 400 credit score, you're putting 10% down and you're able to get an asset-based loan.
If you have a 400 credit score, you're not putting 10% down.
Exactly. So
what I'm 40% down.
What I'm saying is there needs to be financial fitness. And I know it's Stratton, and I dealt with Michael a little bit and his team, that they'll come to you and say, listen, I can get you into this loan, but here's what you're looking at. But if you could get your fitness up, financial fitness up, or put more money down, we're looking at this. And the reason why it's critical, because these are investment properties, you need to either have positive cash flow or bare minimum break even and get the depreciation. Also, Michael brought a good point for our real estate folks out there. Don't think rainbows and unicorns. You will have some vacancy. You will have some people who aren't going to pay. There might be another, black swan event. Have some cash available, even if the property is turnkey.
Oh yeah,
Michael will tell you this because you need it. So that's why all the things, when you have a good Stratton advisor to help you, secure those loans. We kind of touched. Oh, go ahead, Michael.
I'm glad you said that, because the big thing is, I don't really consider us a mortgage company, right? We're a need-based solution.
Yeah.
Right. We talk to people. We spend time on the phone with them. We try to structure their, the way for them to structure their financing. It's kind of like going to a doctor. You go to a doctor and say, "Hey, doc, this is wrong with me. How do I fix this? How do I fix that?" It's not just about just throwing random loans at people, right?
Yep.
It's about knowing how we can utilize the programs we have in a needs-based solution to truly help people and benefit their lives and help them with their investment needs and their portfolio. Not just saying, "Oh, here's a loan, take it, goodbye."
Correct. Well, that's the other.
It comes to the training, because most LOs don't have that training.
Well, that's the other part too. We're in a very dynamic environment, especially now. So, for example, if you get maybe, and this is made up, I'm not even looking at the market, but you might get an 8% interest rate that makes sense financially for an investment property, right? But interest rates may go down, and it may be enough to go back to Michael and his team and say, "Hey, can we refinance?" Or what about you do qualify for maybe like a line of credit or anything that makes sense to support your investments? Because here's the deal. If you get into a property nowadays, the old cap rates are not going to be what they used to be, right? So you have to be really particular about having the right deal and the right partner on board prior to making the deal happen. Michael, who should call you? Real estate investors, give us novices, advanced, give us who should give you guys a call.
Self-employed, again, we because I was self-employed, right? So that's why I structure things the way we do. Realtors, who are self-employed, investors, pretty much anybody that needs to secure financing at lower rates and better LTVs. But yeah, it's just the mentality that I will never change. But if you need to have cash, you want to be more secure, right? People understand also where you need cash. They go, "Oh, I have this much money." They don't understand closing costs, down payment, reserves.
Correct.
People don't understand what reserves are, right? When you do a purchase, especially, and you have X amount of dollars, and now you're left with nothing. We can't leave you with nothing. You have to have money in reserve. Generally, it's 6 months, 12 months reserve, especially in this environment. During COVID, is when the reserve requirements went up. That's when they went up. At that time, there were 12 months reserve. Now they have dropped. If you do a cash out loan, right, we can sometimes waive the reserve because we're going to go, okay, the borrower is going to walk away with $250,000, right? So that can be used as their reserve.
Back as,
Instead of having the reserves up front, we have those options. But if you're doing a purchase, you're going to have, more money. I tell people, if you're going to get an 80 LTV loan, argument's sake, whatever you're buying, you want to have 35% liquid for all the extra stuff, for the reserves, for the closing costs, for the appraisal, and for all that stuff.
Because people think, oh, I only got to pay that 20%, but no, that other 50% are closing costs, etc. Correct.
Yeah. So and again, it's not really, it's just a habit, right? You want to have it. And also you want to be a stronger borrower, right?
Correct.
Markets change. Programs change. You want to be a stronger the stronger of a borrower you are to the underwriter, the faster and cleaner we're going to get this thing wrapped up.
I love it. Now, you talked a little bit about who should use you. Theoretically, when should somebody call you? Should they have the property identified? Should they engage you earlier on, or opposite? Should it be until we kind of get into an LOI? Yeah, when should somebody call you guys?
Oh, yes. So, we like to deal with people that have already secured the property, that have the property in the contract or going to have it in the contract. I tell you what we do not do is, pre-approvals. We're not a that company, right? So come to us for pre-approval and whatnot, and then want to go shopping around.
Correct.
If you're ready, you have the property, or you've already isolated the property and you're ready to go, and then people come to us to secure financing.
Got it. Now, why Stratton? Because I know, again, a lot of firms out there. I've dealt with you. You've been great in terms of our dealings. But why should somebody, click the link and give you guys a call?
I mean, again, right? The customer service and the knowledge that our team has, I've never seen anybody else that has it. The training that they go through, and I'm not just saying that. Honestly, God, I've never seen anybody else that has it, and how much we do, and how much training we do, and management we do. For some reason, in the mortgage world, I've been in for 20 years, nobody trains anybody. It's kind of like being a realtor. They're going to throw you in. All right, go have fun. Do your thing. So people do their own thing. They have their own model. If you talk to most loan officers in larger companies, do you do non-QM loans? No. You do DSCR loans? No. They probably do. They just never been trained on it.
They don't even know about these vehicles.
What they can do. Right? So that's a big thing. And honestly, our rates and programs, I'm extremely proud of. I hear it from the sales team, people all the time, like, how are your rates that low? How your LTVs that high? How can you even get this done? Right? I'm very proud on that. And when rates were in the twos, our no doc and soft money were, I think, at the lowest. We hit like the high threes.
Wow.
High threes. Obviously, those days are over.
Yeah.
But the high threes for a little bit, low fours. When our competitors were in the sixes still, we were half that. Right. And then the LTVs, I'm very proud of it. I haven't seen the LTVs that we've been able to reach. As I said a couple months ago, before things kind of went a little kooky, we were at 85 LTV. Now we're at 80. We're at 85. When everybody else was at 70, 75, we were at 85. So it makes it a lot more conducive for a real estate investor to keep more money in their pocket. They can go do more deals.
Well, also, I think one of the biggest misconceptions is, and you said this, so when there's low inventory, obviously, right, there's going to be a higher real estate market. And let's be honest, real estate market, for the most part, depending where you are, the country's been on fire, right? Even the commercial investment. However, with this run up in interest rates, they have fallen off of a cliff. So, is there a formula or because here's how I look at it, right? The reason why I'm going to look is because I may pay a higher interest rate, but I might get 20% off of ask now, which I never would have gotten before, right? Yeah. So can you give us a little bit about that dynamic when you're looking at a property, and you have an interest rate that's, whatever it is that you have no control over. But, give us kind of some maybe some tips or your thoughts on how to navigate in this current market when you're going to buy an investment property.
Well, I mean, again, my thought process is different. Like I told you, my first loan was 24%. I don't care about the rates. I care about what money am I making. Yeah. Right? People are so adamant about rates because they've been just brainwashed with rates. We're lucky in our world. We're needs-based, we're solutions-based business. But when you're in the QM world, right, it's all about who is lowest rate, because all the programs are the same. right? They're
Correct.
literally the same programs.
Yeah.
So people are just, what is the lowest rate I can get, because the programs are all the same. In our world, right, it's a needs-based business. It's a tailored, program to fit people. So it's not as focused on the rate, is can we get it done, right? The rates are still lower than anybody else's, but can we get it done?
Correct.
So what it has affected is the DSCR, right? So the debt service coverage ratio.
Yeah.
Especially California, New York, right, where the property value is $2 million, the taxes are $30,000-$40,000 a year. It's on the water. The insurance is $3,000. So those properties are having a little bit of a harder time right now, debt servicing and qualifying.
Yeah.
But we have programs that are coming out for that are going to still make it a little bit easier for people to qualify.
Interesting. All right. Listen, I mean, I had high expectations on this call. I learned a lot. I actually didn't know the LTVs were that generous. So I'm really excited about that. For those that are listening, how can we find you, Michael?
StrattonEquities.com.
Beautiful. I'm going to put a link below, obviously for the audio, link in iTunes, or video for YouTube, and then for the audio, be on Spotify and everywhere else. Michael, I just want to thank you for being on the New Theory podcast, man. It's been a pleasure.
I appreciate your time.
Thanks.